Wala palang post to. Need some water. Oh, nakaka-start na pala yung stream. Okay, everyone. I guess we'll be starting early. We'll start about 5 minutes earlier than usual because I pressed on the apparently I pressed on the start streaming button already. Okay, so it is Friday and it is the first Friday of the month, which means that for a lot of forex, not just forex traders, but essentially for people who trade the financial markets, it's a very critical day. Um, First Friday of the month means that the US will be releasing its non-farm payrolls data. Now, to those of you who attended our face-to-face boot camp last 26th, 27th, you know this, that the NFP is considered to be the, shall we say, the most important economic data that comes out for, especially for financial markets. And why? Why is that? Because NFP is essentially a one of the best measures on what's going on for the US economy. Now, let's just review a bit about how the US economy is structured. Now, the US economy, as we all know, is about 70% about consumption. Most developed economies that are not export oriented, they're around 50 to 60% about consumption. Okay, but the US is 70%. The US is the biggest consumer market in the world. It's bigger than China as a consumer market. Although the Chinese have like 1.4 billion people and the US has something around 300 million. If you look at how much they consume and of course the income levels, there's such a great disparity. The US consumer has always been the driver of the global economy. Now, having said that, what are the expectations? Well, let me drag the calendar and see what's in store for us. Okay, so the last time that US NFP was released, we were a bit surprised. We were surprised because, well, it came out strong. It came out better than expected. Came out at 228,000. Now, the last time expectation for this was around, there's your expectation, 124,000, and then you ended up with 228,000. And what was the impact of that for the market? Okay, let's take a look at our charts. Let's see some history. So April 4th, what happened in April 4th? So there we go. There's your April 4 candle. The data turned out strong, but it did not actually, let me just verify. Let me just verify my dates. Okay, let me just make sure that I'm not making a fool of myself. Okay, something's funny here. Let me just check things, guys. All right, yeah. So April 4, which means this candle here. That's why. As I was thinking, why the heck do I have this kind of chart? All right, so this is April 4. Let me just change the color for that. Oh, why am I using this? Sorry, let's use our pen. So this is April 4, guys. This is your April 4 candle. If you look at your chart, you've been trending higher in EUR USD. The dollar was actually getting dumped by the market before that. In fact, the day before NFP was released in April, you had euro surging, and this is not just for the euro. If you look at your charts from a multiple perspective, okay, let me do this. Let me highlight this thing. So that's the April 4 candle. And if we switch our instruments, okay, let's take a look at your cable. That's your cable. Big sell-off in GBPST. If you look at your Aussie, big sell-off in Aussie. Essentially, market was surprised last time that the NFP turned out, and that surprise led to a very strong dollar. Now, I myself, the way I recall things is that when NFPs were coming out last April, my thinking was that's going to be a bad number because these data was gathered at a time when the US federal government started kicking out some of the bureaucracy, started terminating people. And my thought was, okay, we could actually get an upside surprise. And in fact, I think that one of the reasons why your euro the day before rallied, your GBP the day before saw some new highs, was the idea that people were pricing in a bad number. And that's something about data. If the market prices in a bad number and you come up with a different story, you could expect some very wild movements, which is what we had the last time. So the question ahead of us is, are we going to get the same kind of price action later? We have to remember that I think this time around, market is more aware, market is more conscious about the potential for the numbers to surprise. Although if you look at forecasts, what do we have? Consensus forecast is at 138,000. And oftentimes if you see the actual figure overshoot the forecast, then the subsequent period sees the number underperforming. So what am I saying? I'm saying that this is still the time when a lot of those federal jobs in the US were getting eliminated. Okay, this was still numbers from March. So a lot of federal jobs were getting cut at that point. So there is a possibility that we end up with a weaker number. Consensus forecast is 138. Maybe we fall short of that. And if we fall short of that 138 data, how do we respond? According to textbook, if the jobs market in the US is faltering, if it's slowing down, then that's a bad sign, because as we said, 38% of the rather 70% of the US economy is about consumption. So if you're facing that kind of situation, one of the things that I ask myself is, was there a pricing in of bad numbers from the market? Did we see a weaker dollar in the days ahead of the release? So did we see dollar weakness yesterday? Did we see dollar weakness Wednesday? Could I say that the market has priced in a bad data? And if I look at the charts, actually Thursday, Wednesday, they were actually good days for the US dollar. Okay, you look at your euro and we actually eased off for the previous 3 days. Same thing with your GBP. We were mixed in our Aussie. In fact, even your Japanese yen, USD JPY, saw a stronger dollar before the data. And right now, as we said, anecdotal evidence would suggest that we end up with a weaker than consensus forecast. So what am I saying? I'm saying that we actually have the potential for a wild ride in the US session later if that non-farm payrolls data does come out weaker than expected, because the dollar strengthened in the days ahead. And if we see an excuse for weaker dollar, if the NFPs come out poorly, then that's an excuse for you to say, okay, you know what, maybe we should reverse the price action that we saw in euro, in GBP, in dollar yen, in even in gold. We should reverse the price action that we saw from the last 3 days. Now, before I totally leave this topic, let me point out that your NFP numbers do not come alone by itself, okay? It is accompanied by the unemployment rate, and then of course you have your average earnings and your labor participation rate. We don't have that in Forex Factory. Let me just see if it's available at Trading Economics. By the way, we're not sponsored by either of these websites. These are just the tools that we use, that we look into. All right, so they're not updated. All right, so I don't think that oh, there we go. Okay, so non-farm payrolls, there you go. The participation rate. It was 62.5 before. It's expected to remain steady. Let's see if that participation rate does remain steady. Now, remember, a lot of those people who were terminated from the federal government, from their federal jobs, would likely be looking for new jobs. Okay. Now, participation rate, guys, is basically the number that tells you how many, what percentage of able-bodied people are out there looking for work or out there working. If somehow you got terminated or you lost your job and you decide not to go look for work, then you're not considered to be part of the unemployed because you're not looking for work. You're not considered to be part of the labor force because you consciously decided that you don't want to go look for work, which means that that's going to weaken the participation rate. Now, sometimes you have the participation rate dropping essentially because of this idea that people just find it too frustrating to go look for work. People just find it too hard to get a job, so they don't make the effort, and if they don't make the effort, they lower the participation rate number. So later, everybody, the headline number will always be your NFPs. People will be focusing on that. Anything below 130 would be an excuse for us to say weaker dollar, especially when in the previous 3 days you've had the dollar slowly strengthening. Okay, so we've covered our potential catalyst for changes in market structure for price action. But what do we have in store for us? Now let's look at the charts. Over the past hour, we've actually bounced up a bit in our euro, but I'm getting ahead of myself. Let me just see this in the big picture. And what is the big picture? These are daily charts for your euro. And as we said, for the previous 3 days, you were dropping. Overall trend is still this bullish trend line. You know, I am getting the feeling of, we are going to have potentially, we're going to have a weak read in those non-farm payrolls data. So I'm thinking, do I have an excuse that says bounce off this trend line and go rally back up? That's what well, probably we should say that's what we're hoping for. But let's see how this chart looks like if we go in today. So we have an uptrend. We have consolidated. This is your wider consolidation. This is your tighter trading range. Now, okay, one of the things that I normally do is I always want to check what is the average true range of a chart. So average true range have actually been easing off lately. Average true range now for the past 20 days would give you around 125 pips. And what kind of price action have we seen today? Well, we have highs for euro at 13.29, lows at 12.74. So that's barely above half, or actually that's below half your average daily range. So what am I saying? I'm saying that there is room to maneuver if we do get that data. Regardless of what the data is, market would need to move. Okay. Now, by the way, we are at the open of the London session already. I'm not really keen about taking an immediate action, but let me just see this. Okay, if you're going to trade the London Open, let's identify what is your pre-London consolidation. So this is the high of that London trade. This is the low of that London session. Now, we call this the London Open session because we want to capture the momentum, the breakout from that pre-London consolidation. So what are we going to do? We'll be placing a buy stop above the high or just around the high, and a sell stop below it. Although honestly, my bias for this chart is to really go look for a rally considering the data later. Now, what are our expectations? Okay, guys, so when you look for price targets, you always have to consider where is the previous high, where is the previous low, where are these consolidations, liquidity areas, depending on which particular technique you actually use. If I look at my chart, I find that we have some highs around this level. That's around 1341. Not exactly a very nice target given that our entry will be around 1330. So you're just talking about maybe getting another 10-11 pips if indeed we do get a bullish breakout in euro already. Well, let me just zoom out some more in our chart. And what do we have here, folks? So essentially, we have these consolidation lows here around 1360, and then a bit of a supply consolidation highs around 1390. So if we do get a breakout on the top side, our objective would be to see if we can get towards 1350, 1360, 1390. Now that's not an immediate trade for us. That's not something that that's going to last for only, sorry, that's not an immediate trade for us. Again, we are looking for data later to provide the catalyst for even more than that. Technically, with our lows at 1274, we should be thinking in terms of getting towards 1400 as a nice target using your basic statistics, using your daily averages. Then I'd look for that 1400 area. Uh, at this point, let's just see what happens, guys. So we are bullish. We tend to think that US data will be a catalyst for a rally. Now, we did place a sell stop. What about our sell stop? How do we handle that? If indeed there's a break of the 1320s region, let me just get the exact price. We have our sell stop at 1317. If indeed we have a break of 1317, our price target for that would be to try to get to 1300, and then these consolidation lows here around your 1270 region. But from the looks of it, we may be pushing for the upside on this one. So we do have some bullish bias. We're hoping for a bullish breakout. Now, I'm just testing our, if you guys attended our boot camp, we said that we will document how to trade a small account. So we're going to test that here with Southwest. Target for this would be, I have to modify this thing. We'll place our TP for that at around, like you said, these resistances here. That should be around 1360s. And then our stops, ideally the stop for this, because we're just actually trading the London Open, we're not gonna use some wide stops. Our stop losses should be below the low of this latest swing. This is your latest swing, so below the low of this candle, that's about 1316. So let me put our stop below that 1316 area. Wait a minute, looks like we've been triggered. So stop loss 1315. Our target will be to try to get to 1360, then 1370. So let's see what happens, guys. So again, we have resistances here. So that's where we're going to put our target for the buys, around your resistances. Ideally, average ranges should have us heading all the way up to your 1400 level, given that we have the highs at 1330 right now. We have the lows at 1274 and average changes of about the ATR is about 129. Okay, so our London Open is there. We've been triggered. Now, if you were trading purely London Open, you should be looking for the closest price target. Right around these resistances. Remember that London Open, Asian range trade, these strategies, these breakout strategies are supposed to be capitalizing on liquidity that comes with the open of a financial center, in this case London. So you're not really looking to do a swing trade if you're focusing on a London Open trade. Okay, although right now we're saying that there's a lot of argument to go look for more, to be ambitious about just how far the market can go, because you have catalysts in the form of US NFPs later to really move the market. Okay, so the dollar has strengthened the last 3 days, and we're expecting that figures later will be disappointing and leading to a reversal of the good fortune that the dollar has seen from the last 3 days. Now let's take a look at other charts at this point. What else would be interesting? How about gold, guys? Gold has given us doji, doji, doji. So what do we have for gold? So dojis for the past couple of hours. The last R was a high wave doji. Indecision. What's the context? Okay, context is gold has just come off its latest historic highs. Again, it's come off because over the past 3 days the dollar has strengthened. Was there a really significant excuse for dollar strengthening? We tend to think that the dollar strengthening is more a result of the conciliatory tone that we've had from the US, but they're not saying that the tariff war is over. It's still there. So let me do some stuff here. Let me drag some fibs, okay? The first question that I have whenever I see that a chart is coming off a nice swing is, okay, what kind of retracement have we seen already? And what do I have? Okay, so pulled back to 50 fib retracement level. Looking to bounce off that 50 fib area. Nothing in your daily says that that's happening already. And just like any asset today, any other asset today, the focus really will be on the non-farm payrolls later. Are they going to disappoint? Are they going to fall short of the forecast? Are they going to say that we will see NFP, we will see the US labor market essentially getting hammered, getting crushed? Okay, will those job cuts from the federal government finally translate into a weak NFP number? And remember, guys, that the market has been waiting for this to happen. Okay, we say that the market has been waiting because if the US government decides to cut jobs, how does that translate to the private sector? Well, there are two ways of looking into this. First is in communities where the federal government essentially is the biggest source of jobs, is a big source of employment. You cut the workforce, you fire people there, and all those private businesses that supported, that provided the comforts that the government workers needed, they would also feel the pinch. Their business would slow down. And if their business slows down, they might also decide to cut jobs as well, especially in the service sector. And another impact of the job cuts from the federal government is it drives, for one, there's a potential of driving salaries lower because you're now increasing the competition for jobs that the private sector offers. So it's not just a job cut. It's not just a one. It's not just a single transaction or single action here, but it is fuel for what could be a series of actions. Okay, there will be a chain reaction in the jobs market from what the federal government has done. So will we now see that later? Let's see. We are about, let me see, how many hours away are we? We're about 5 hours and 15 minutes away from that data. So what can I do in gold? As we said, it's strengthened as the dollar strengthened the past 3 days, and we have the potential for that strengthening to be reversed with NFPs later. If I go lower time frame, what kind of patterns am I seeing? Well, you've had a hammer from your 50 fib retracement level. That's the 4-hour chart. Let me go hourly. Hourly, okay. We've had actually a bullish reversal pattern in the hourly chart getting triggered. This is an inverted head and shoulder pattern here. Okay, this is the neckline of your inverted head and shoulder. That's been triggered. That's your breakout. And how do you trade this kind of data? Well, or rather this kind of pattern. Well, you just get the distance between. Okay, let me use the platform's lines instead of the pen. So this is our neckline for that pattern. And if you're going to trade an inverted head and shoulder, what you want to do is you get the distance between the lowest point to the neckline. Okay, I can't do it. I just use this instead. So what's this? You project it from the breakout point, and that gives you the target of your inverted head and shoulder. So we're saying that there's this inverted head, shoulder, rather shoulder, head, shoulder pattern. This is the neckline. This is the distance of the neckline and the lowest point. So let's call that A. And when you project that A here at the breakout point, that's A prime. That's just the distance. That's the target of, or that's your pattern target for gold. Can we go beyond that level? Remember that we have a catalyst. So we have the pattern already as far as the charts are concerned that says this is this is going to pick up already. We are coming from a nice Fibonacci derived support level, 38.2 fib, rather 50 fib retracement level. If you look at the chart, you can also see some consolidation around these levels. So we are well supported. We're bouncing off that support level. Our target is to get to that 32.90 level. And we have catalyst for that. So let me just clear this up. So we're bullish, we have a target, and we have catalyst. Catalyst later could potentially see us moving by a lot. Again, your jobs data from the US. It was a positive surprise the last time. Typically, when you have positive surprises, you end up with a negative surprise the following month. And if you look at the big picture here, this just looks primed for me to get to that 32.90 area and get back inside this consolidation from the previous week. I'm not expecting new highs immediately, but play this bigger range is something that I'd be looking for. Okay, let me just clean this up. Let's take a look at the charts again, see if there's anything interesting. We're not really having momentum for our euro breakout. What else looks interesting here, guys? So we've seen gold. Let me take a look at the Rockwest platform. See if there's anything else that we can look into. So we're not doing developing momentum. Now, I'm not really a Bitcoin person, so let's skip that. Energy. Okay, let's take a look at oil. Take a look at Brent. Of course, fears of a recession has led to that big sell-off in oil. The potential for peace also contributed to that sell-off. But what do we have now? It looks like I have limited range in charts. Let me go dailies. Okay, so I'm thinking that we could be forming a pattern here. Let me just add some lines. We actually have that hammer. I'm wondering if this is a decent triangle. It's a bit steep. So obviously you're trying to get to your resistance line. Anything here that says go jump in immediately? You seem to have lost momentum already. But these are 4-hour candles. These are swing type of trades. Let me go hourly. Pull back. All right, let's work with that. So here's your upswing. I just want to point this out, guys. 50 fib retracement and then bounce. Okay, so it looks like you have an indecisive chart. Now, how does oil prices react to payrolls data? Well, the simplest logic is an increase in payrolls means that people are likely to be driving more. They've got the jobs, they can afford to pay. They'll be confident about consuming. So transport sector, in theory, also benefits from it. And if the transport sector benefits, then you do end up with an excuse for to say that there is demand for oil. But I guess at this point, my main issue with the chart is we just don't have what it takes for me to say that I'm bullish with oil already. Now, if you start giving me hammers here or some dragonfly dojis, then yeah, fib retracement level would be a good, would be a good place to go long. Although ideally, I would say you should be thinking in terms of picking things up from here. Previous consolidation highs, just around 38.2 fib retracement level. So best to just wait for hammers or dragonfly dojis from that 62 area before going long in, this is a Brent crude. So no immediate action. We don't have a catalyst at the moment. Let's look for better prices in oil before taking action. Let me just check on something. I just want to see how big of a dip have we seen in energy prices. It's quite a lot actually. So yeah, we're bullish, guys. At least we're thinking in terms of, can we have better prices from which we can buy oil at that point? So no immediate action from the current price level. And looks like we've totally lost momentum for that euro breakout. I guess that's one thing. When you do have key data like today, there's a tendency for markets to move the highs just a little bit higher, move the lows just a little bit lower, but nothing very convincing happens until you actually have your key data released. So for the rest of the day, at least until we see the NFP numbers, we're likely to just consolidate in our intraday charts. We do not expect to see any big breakouts happening. And again, oh, by the way, since we're talking about data, how do we trade economic data? Now, the problem that we have with trading economic data is that we at the retail level are always the last person, the last people to know about what's going on. So once you have, okay, we're just going to draw here, guys. So if in case you do have your bad numbers from the US later and you see that the dollar is getting dumped, you don't want to join that initial spike because for one, there's really no liquidity. If you click here, you might find yourself executed here at the top. You might get the top as your open price. So you want to avoid that. So no immediate knee-jerk trades once the NFPs come out. Best thing to do is allow for markets to move the first 5 minutes. See how far that thing goes and then assess. is the number really that pessimistic for the US? Is it really that bad? Because if not, then I would consider instead doing some mean reversion trades. Say the data comes out as expected, but you still have that spike because you've got some, well, you will still have that spike because automated systems will respond. So what I'll do is allow for the first couple of minutes, allow for the first 5 minutes, and if you begin to see hammers and rather, if you begin to see shooting stars and gravestone dojis in the minute chart, if you start seeing these kinds of candles in the 1 minute chart after the first 5 minutes, then that might signal that it's time, that could be the signal that it's time to do a mean reversion trade. But remember, we only do this if we do have a number that's just in line with expectations, just consensus forecast. Now, if the numbers are really good, how do you respond? Well, if the numbers are really good, and of course, like we said, it's a bad idea to jump in on the initial surge, then allow for the scalpers, the algos to take the trade. And once those guys book their profits, you look for the pullback. And then you join after this. So this happens normally after the first 5 minutes. If the numbers are good and you start seeing profit taking from the early adopters, the early traders, then wait for their profit taking to happen and see some decent numbers. Normally, I would say you should be pulling Fibonacci retracements at that time. And look for those 38.2 fib retracement levels, 50 fib, 61.8 fib in the minute scale. And once the pullback happens, you see those kinds of prices. That's the time for you to jump in and take the long side, assuming that you do get some strong numbers from the US. So guys, thank you for joining, and I will see you Monday. In about 2 weeks time, we'll be doing a session on how to do EAs, how to develop your EAs, how to develop your CBOTs using Grok. So hope you guys attend that one.